Great start. Hello everyone. I'm indeed Michael Bishop. It's my company Declarative Solutions. I'm here to give an amazingly exciting talk about accounting for tech people, so I hope you're all really pumped for this. First of all, a little bit about me. This is me if I had hair. Very handsome. I am a Salesforce and FinancialForce consultant. I spend most of my time installing or integrating FinancialForce accounting with the rest of Salesforce, which I really enjoy. I am a chartered accountant for my sins. I was a CFO, I had a bit of a career change, so now went to the dark side or light side, depending on how you view it, and I'm a techie. Lots of experience in Salesforce and FinancialForce. As Anoop says, this talk came out of realization that so when I'm working with accounting teams, finance teams, hey, I speak the same language, we understand each other, it's great. When I'm talking to, and I've learned that language, I know where they're coming from, know what I'm doing, but it's not really much of a crossover between them. So what I find is if I can do something like this for the IT people, it just helps bridge that gap a little bit and get a bit more of common understanding. And I also follow it up with how FinancialForce 1 works, which I'm not doing tonight, but you know, just to get you a bit closer to understanding how it all fits together. So this is what I'm going to be talking about. It's exciting. A little bit about what I'm hoping to get over and what I'm not hoping to get over. Some concepts, principles. Beautiful double entry. Double entry is beautiful. I will repeat that many times. Some of the key processes. I'll give you some brief examples and some of the language. Half the battle is language. Accounting has its own language. There's at least 2 words for everything. They mean different things. So you know, it's a bit like tech actually in that respect. So what am I trying to do? Well, I'm not trying to teach you how to be an accountant in half an hour or so. Impossible. It's a noble profession. It takes years of study and learning and what have you. And I should also say that there are all sorts of different sorts of accountants. There's tax accountants, there's solvency accountants, there's people who, I don't know, value companies. This is more focused on management accountants, the sort of team that you'll have in most organisations are sat in the corner, busy beavering away, producing reports for the executive team, what have you. So it's that kind of accounting. So I'm hoping to help you understand some of the language, double entry, key processes. But just to say that it's actually a legal requirement to keep books and records for companies. It's Companies Act. And there's like volumes of rules and regulations and guidance as to how you do it. And if it's like if you're a listed company, it's even worse. There's more books and volumes and what have you. So the guys that sit in the corner know a lot, and you know, and there's lots of judgment, and it's quite a tricky, complex thing to do. So just to get you a feel of the noble profession of accounting. Okay. So I might be teaching how to suck eggs, but profit and loss. We have income or revenue, we have expense or costs. Hopefully the income's more than the costs and you make a profit. Hooray! If the expense is more than the income, obviously that's a loss. Boo! And that's all part of what they call the profit and loss account. On the balance sheet side, there are assets. Now, these are the things that you own. So it could be a car, it could be a building, it could be somebody owes you money, it could be cash. They're all assets. Or liabilities where you owe somebody money. You borrowed some money, you need to pay it back, what have you. Or have you bought something, not paid for it. And the sort of short-term one, long-term ones, all sorts of different types. And then the concept of a ledger. So sort of income, we might have different types of income. We might have selling consultancy services. We might have selling software. So they would all have a line to themselves on a ledger. And when you account for something, you code it against that line. And we have things called a nominal ledger or a general ledger, because everything's got lots of names, that everything's recorded on, everything you do. But then you might have a sub-ledger. So if you sell something to somebody, on the general ledger it will just say, I've sold £10,000. On the sales ledger, it will say I've sold £10,000 for this invoice to that person that's due this date, it's in this currency, etc., etc., etc. So it's like more detailed information, and the two keep in track. These days it's all done on systems and it's automatic, but you can imagine the old days it was quite a task. So really basic concepts. Counting principles. I googled this, and you get various things. More or less this. These are the ones that I learnt 30 something years ago, so I'm sticking to them. The first one's really, really important, the accruals concept. So this is all about, the concept here is that you should account for things in the period to which they relate. Obvious. But if you think about it, if you buy something, you might order it in advance. You buy consultancy. You might buy some very valuable FinancialForce consultancy from somebody. You order it in advance, let's say it gets done in February, that firm might invoice you in March, you might pay them in April because they've done such a wonderful job. Where do you account for it? The Accruals concept says you account for that in February because that's when the work was done. And it's a really key concept. And you can flip it round to the income side. So let's say I'm doing my books and I've done some work for you, and let's say it's a fixed price contract, 3 months, £30,000 to install and integrate FinancialForce. Fantastic. I'm there at the end of month one. What's my income? Well, you might say, well, it's £10,000. It's obvious, a third of £30,000. But perhaps I haven't really done any work in February. I'm doing all the work in March. I'm just a bit of setup in February. So you need to think, well, how much income do I accrue? So this is where you get into things, judgment calls, things like revenue recognition policies. You need a policy to decide how much you recognise in a month. So that's all the accrual concept thing. Prudence is my favourite. Lovely prudence. As accountants are sort of cynical, you know, dour creatures, and we sort of suck our teeth a lot, and the concept here is that if you're accounting for costs, then if it's likely that's going to happen, then you should account for it, and you should err on the side of caution. You know, you're going to pay for that and it's going to cost you. If you're accounting for income, then you only book it if it's reasonably certain. You know, you don't just say, oh, that might happen, I'm having that. So it's like two sides of the coin. And prudence is fundamental. You can play all sorts of games with this, but it'll bite you in the end. It's sort of based on years of experience. Consistency. I talked about a revenue recognition policy to decide how much revenue you recognise, so that trends are consistent and all that kind of thing. And in practice, you will have a whole load of policies that you will decide on and you'll publish, and you should stick with them so it's consistent. You can change them. It's a pain in everything that's happened before, and you really don't want to go there. Matching is another key one. So this is about, say I've said, well, this much income is for this month. The costs relating to that I've got to book as well. I can't say, well, the income's this month, but the cost is that month over there. Hey, aren't I doing brilliantly? You've got to match it all up, square it up. It's a key thing. And then this is an interesting one to my mind, because it's kind of one of the differences between accounting and tech, the time periods theory. Something like an accruals, you don't do it every day, you do it for a time period. They're usually months, calendar months is the most common. But it could be 445, could be weeks, there's no set rules. So you book things to a month. And so when you're wondering about what your costs are, you say, right, what's come through the month, what hasn't come through, what do I need to accrue? So doing it for a month is an important concept. By the way, I forgot to say on prudence, this whole business about only taking income if you're reasonably clear about it is at direct odds with how salespeople work. Sales forecasts, they really have to be optimistic. They really have to be optimistic, and you know, good luck to them. It's a tough job. But as accountants, well, that's never going to happen, you know. So that's, again, it's kind of one of these fundamental differences in point of view between different teams of an organisation. Right. beautiful double entry. Again, I googled when was double entry invented, because it's been around a hell of a time. And what you get out of Google is there was an Italian mathematician called Lucio something or other who in 1494 wrote down the first, this is how double entry works, 1494. But even he said, guys, I'm just writing this down, I didn't invent it. It was used by the traders in Florence and Venice at the time. But apparently in the British Museum there's some Babylonian clay tablets that are thousands of years old that have double entry bookkeeping on it. So, you know, this has stood the test of time. It works. And the double is that every transaction you record it twice. You have a debit, which is positive, and a credit, which is negative. This sometimes confuses people because on your bank statements when you go overdrawn it says debit. And that's because banks being banks see things from their point of view, not your point of view. So from their point of view you owe them money, you're a debtor. But from your point of view you owe them money, so you're a creditor. Whenever you record a transaction it's held against the ledgers I was talking about, so debit, sales ledger, credit, income, what have you. The aggregate of transactions always equals 0. I mean, this might seem fairly trite and obvious, but it's really important. And particularly in the days when everything was written down and hand added up and what have you, if you got to the bottom, you added it all up, it wasn't 0, something's wrong. You knew something's wrong, you had to go and find it, you had to go and fix it. So it has inbuilt sort of self-checking mechanism. And even on systems, some systems it can be not 0, and you need to know, you need to fix it. Glad to say on FinancialForce, it's always 0. Really. And then the concept of a balance, an aggregate value. Again, some techies that are not used to this. I mean, it's not brain surgery. It's fairly obvious, but you know, the sum of transactions up to a point of time is a balance. So we'll talk about the balance on the ledger as at the end of February, and it literally is the sum of everything that's been coded, posted to that ledger since the beginning of when that organisation started. It's a balance, aggregate value. So again, here's some of the basic concepts. I'll be doing some examples in a minute, but first I want to talk about some of the key processes. Sales to cash, I deliver a service, I send an invoice out, hopefully you pay, so you end up with income and money in the bank. Purchase to pay, you order something, goods or services delivered, you get an invoice, you pay it. Accounting adjustments, there's all sorts of different types of accounting adjustments. I talked about accruals before. There's things like depreciation. So if you say buy a car, £50,000, and you decide that it's going to last 5 years, the way accounting works is it says, well, when you buy it, it's an asset. I've got £50,000 worth of car, but I really need to charge that to the business over the life of the car. So if you say it lasts 5 years, then you'll charge 10 grand to each year as a cost to the business of using that car. And so there's nothing's happened, nobody's bought or sold anything, no cash has changed hands, but you need to post a transaction to reflect that. And so the concept of month end becomes really busy. I should imagine that in most of the organisations you work for, that team of accountants sit in the corner are really busy at the month end because they're busy beavering away, doing all these adjustments, figuring out what's a reasonable, how the business is doing for that month, and telling the executive team. You know, they're all working late and cursing you when the systems are down, etc., etc. But that's what they're doing. So now some really exciting examples. I'm sure you really wanted to do double entry accounting when you came out tonight. So here we go. Transaction 1. So we're saying we're selling £1,000 worth of really high value, value for money, I should say, consultancy to client limited. So we are debiting because everything's got a debit and credit. I've dreamt up a coding structure. It's 3,000 is the sales ledger. It's not just the sales ledger, it's the client limited bit of the sales ledger, and they owe us, client limited owe us £1,000, so I'm recording that. And I've got 1200, dreamt that up. Consultancy sales, this is income. This is part of the profit and loss. This is balance sheet, this is profit and loss. So I've got some income. Note, income is minus. This is a bit weird to people as well. What happens when you actually produce management reports for the P&L, you flip the sign around, but in the system, it's minus. Transaction 1. Done a wonderful job. Client's really happy. They pay before the due date. They're so happy. So what do? You debit the bank account, and it's not just the bank account, it's the Lloyd's current account. It's like a sub-ledger, £1,000. Credit the sales ledger, because they don't owe you any money anymore. So you knock it off, and that's closed, it's been matched. Boom, minus 1,000. Plus, minus, boom. And at the end of period 1, what do we got? So here's our trial balance. We've added up all on 1,200, we've got income of minus 1,000. Our sales ledger is nil, and we've got money in the bank, happy days, £1,000. Minus 1,000, 1,000, nil. Whee! Isn't it fantastic? Flip side, when you're buying something, so we're going to buy £500 of inferior consultancy from the supplier limited. We debit costs, part of the P&L, we credit the purchase ledger, we owe somebody money. We owe supplier limited £500. We've got it on credit, so we haven't paid it yet. Never guess what? Next thing we do is we pay them. So we're debiting the purchase ledger, we don't owe them anymore because we paid them, and we're crediting the bank account. And again, trial balance, period 2, we've still got our 1,000 sales, we've got our costs now. Note the difference between these two is our profits, hopefully. Sales ledger's nil, we've got 500 now in the bank, purchase ledger's nil, minus 1,000, plus 500, nil. Whee! Marvellous. Talked about accruals, so this is like an adjustment. So I'm sitting there, well hang on a minute, I haven't really made £500 because I have to pay my rent. And my rent bill hasn't come in yet, so I've got to accrue for it. I don't really know exactly how much, but I'm going to guess. I'm going to guess £200. So I'm going to debit £200 to costs. And this accruals account, it's like I owe somebody something, but I'm not entirely sure how much. You might even not even know who, but you probably do. So this is like a guess of how much my rent cost is in the period. But then it comes through, and it wasn't 200, it was 210. Not a bad guess. So I'm going to debit my costs with the real thing and credit my bank account, because I'm just going to pay it straight out of cash. I'm going to reverse my accrual. So I'll debit my accruals, so accruals is now nil, and I'm releasing 200 to rent costs. So actually, in the period, I've just got a net impact of 10. So my guess of 200 wasn't bad. I'm truing up with my 10, and that's how it works. So you can see that there's lots and lots of judgments. There's lots of things that aren't black and white. There are lots of things that are black and white. You need to try to process them. But, you know, that's a quick example. Right. There we go. You're all now experts in accounting. Double entry. Hey, you can charge people for this. Yeah, as I say, it's a tiny little slice to introduce you to some of the ideas and concepts. There's loads more. So I hope it was of value. And any questions? Stunned silence. Go on. There's no accountants. Oh, here we go.
The example you gave about the car, you mentioned something about it depreciating. Presumably that means it's less valuable. How do you account for that?
Yes, so, good question. So let's say I bought my car for £50,000 and I'm going to do a whole year's worth of depreciation in one go. So when I bought it, let's say I bought it for cash, I would have gone debit, fixed assets, car, £50,000, credit cash. So I've got £50,000 less cash. And then year one, I'm going to say, well, that car isn't worth £50,000 anymore. It's worth £40,000, and I'm going to charge £10,000 to the business because I've used the car for a year. So that would be credit, fixed assets, debit, depreciation costs.
So the depreciation, would that be managed in a separate ledger and a separate?
Yes, this is the answer to that. But lots of systems work different ways.
Sure.
You nominal or general ledger, everything goes through that, and then your sub ledgers will have the detail. Well, it's this car and blah blah blah.
I see.
Yeah.
Thank you.
in a scenario where you're working across multiple currencies
Yes.
and multiple exchange rates,
Yes.
so do you use an exchange rate at the point in time of the transaction, like to fit your accrual concept, or do you do it at the point that it comes out of your bank when?
That's a lovely question. There's whole books that explain what you're supposed to do, but broadly speaking, I think what you're supposed to do, because I am a chartered accountant, I pay my dues, but I'm a little bit rusty. When you expense something, you should expense it at the rate prevalent at the time. I mean, most people have a rate for the month. And let's say you bought it on credit, so you get sent a purchase. Let's say you bought it in dollars. It's $10,000. So during the month which you've used it, the exchange rate is, I don't know, 1.3. When you actually paid it, it was 1.2, and that goes through the bank. The difference is an exchange. I can't remember whether it would be a gain or a loss, but you actually account for the gain or loss. So obviously in the original currency it's all flat, it all comes out to nil. But when you translate it to what FinancialForce calls its home currency, the currency in which you do your books and records, you get an exchange gain or loss. So the movement on the currency, the difference in your local currency goes to the account. But as I say, there's all sorts of funny rules and. There you go. Well, thank you very much.